So, yeah, let's hear it for Raoul. Well, Raoul, you can't see the audience, I don't think, but it is absolutely packed here in Australia. So thank you very much for joining us. My name, everyone, is Jamie Coots. I'm the Chief Crypto Analyst at Real Vision. And of course, we have the co-founder and my boss, Raoul Pal, here today, all the way from San Francisco. Should have been in Miami, but as it turns out, the domestic aviation industry in the United States is just as fucked as the one here. So he is actually in San Francisco from his hotel room. Say hello, Raoul.
Hey, Jamie. Hey, good to see you, everyone. Sorry I can't be with you, and I'm stuck here, but, you know, there are worse places than California, I've got to admit.
That's true. You've had a very busy weekend. We won't go into all the fine dining adventures you've been having with people in Silicon Valley today. We're going to be talking about, I guess, the philosophy of Raoul Pal. It's hard for me to see everyone in the audience from up here, but maybe just a show of hands. Who are you are actually from the Real Vision community? Can we get a show of hands? Wow. Okay, that's phenomenal. So there are people in this room who are maybe crypto curious, who don't know much about the platform itself, Real Vision, or about Raoul, which is almost impossible at this point given his reach across the entire financial ecosystem, but especially in digital assets. But Real Vision is a financial platform, research platform that has completely transformed the way the public gets access to financial insights and information. It was started by Raoul in 2014. I joined the platform in 2014 as a subscriber. Now I have the privilege of working with Raoul and continuing that mission. Now, Raoul is not only the co-founder of Real Vision, he actually runs one of the longest research publications called Global Macro Investor. This publication goes into the hands of the world's largest investors. I kid you not, the world's top family offices, high net worth individuals, sovereign wealth funds, hedge funds, subscribe to Raoul's Global Macro Insights. And when he's not doing that, he runs an asset management business that's investing in digital asset managers specifically. So he is all in on the digital assets space. And I don't think really it's an exaggeration to say that he would have to be one of the people that has probably orange-pilled and brought more people from the traditional finance space, including myself, into digital assets full-time to realize the full potential of what this technology is going to mean for the rest of the world. So today, really, Raoul, I think one of your gifts is really how you distill very complex ideas or market insights into a way that everyone can appreciate and understand. So for those of you that are maybe not familiar with the philosophy of Raoul Pal and the Real Vision platform, he is able to basically distill these very complex ideas down into memes. And Raoul, better than anyone, especially of his age, which is quite amazing, that he is able to understand the powers of memes and the powers of memetics. So today's presentation, well, the fireside chat is really Raoul talking, not me. I'll ask a few questions. But the title of it is How to Unfuck Your Future. And that's another great thing about this space. We can swear. So, Raoul, maybe you can just share what you actually mean by that meme, because it really does encapsulate your philosophy about investing in the space and I guess the challenges that we as individuals, but also nation states face as we go forward.
Yeah, I mean, it's a catchy title, but really it's something much more profound, something that had been with me my entire career. See, my background was global macro, so I looked at the global economy, trying to understand how it moved, how it affected asset classes. And from the late 90s, when I was still at Goldman, I realized that we were in a debt supercycle. Now, that debt supercycle, at first we thought it might blow up in 2000, but it actually ended in 2008. And it was a spectacular collapse of the global financial system that was eventually stopped via printing of money, which was something we had not really seen in our lifetimes. Yes, central banks had created money supply issues, but never of the magnitude of direct intervention using the balance sheet of the central banks around the world. And what that did at that time was a bit of magic. Everything stopped falling in price. And none of us really understood it then. We thought, oh, well, they've just given us free money and interest rates are zero and everything's okay. But what they'd actually done was lowered the value of the currency itself, of fiat currency, and the dollar is the world's reserve currency. And it means that assets, or the collateral of the system to be more exact, had optically revalued in price because the denominator had gone down. So for those of you who think, what's he talking about? Think of something like the Venezuelan stock market. It goes up in a straight line because in reality, it's the bolivar that goes down in value. So what we're seeing is the value of fiat currency going down. Most of us didn't quite understand what was going on back then. 2012 came and Mario Draghi had the whatever it takes moment. And that was yet another moment where the central banks around the world decided that what they need to do is not allow collateral to go bust or the system was going to go under. Okay, fine. The other thing that happened at that point is they kind of had a debt jubilee. They decided to bring all interest rates around the world of all the developed nations to zero. And that meant everyone had breathing space from which they didn't have to pay the interest payments. And that went on for about 10 years until about 2016 or so, and for some countries even longer. Now, at that period, asset prices started to rip. And people didn't understand it. They talked about it being because of zero interest rates. But the reality was something else had happened. What had happened was the central banks were undergoing a massive wave of financial repression, something we'd not seen since the 1940s after the World War II debt overhang, all the way through to the 1950s and all the way into the late 1960s. Financial repression is a system by which they essentially print money to pay the interest on the debt. They then try and run nominal GDP hotter than the interest payments. And what happens over time is you deflate away the debt. Okay, that all sounds well and good. What does it mean for anybody? What it means is you're all fucked. What it's doing is things like variable inputs like wages or business earnings are not correlated to the debasement of currency. People get confused between inflation and debasement. What debasement does is increase the price of assets. So you guys are all in Australia and you have an understanding of how ridiculous the housing market is. Your housing market is driven by two factors. One, the immigration rate, which has kept the Australian economy strong for a very long period of time. And two is the global debasement of currency. The global debasement of currency is happening at about 8% a year. And plus you've got about 3% global inflation. Your hurdle rates to your wealth is 11% a year. Now your wages aren't going up 11% a year, therefore you are getting poorer. And what we're finding is the cohort of younger people, particularly, have realized, unlike my generation, I could buy a property at 3 times earnings. That doesn't exist anymore. It's 10 times, and in Australia, it's even higher. And this is a function of how screwed our future is, because we can't buy assets. If you think of the ASX 200, it's more expensive than it's ever been in terms of kind of units that you can buy for your income. Again, it's the same problem with gold, and it's the same problem with, well, it's the phenomena that drive cryptocurrencies. And what this means is when assets get more expensive, we can afford less of them. What is an asset? An asset is future deferred consumption. You lock up money for a period of time, let's say for your pension, and in 30 years' time, you unlock it and you should have had gained wealth. You should have been compensated for locking it up for a long period of time. What's happening is you're not. It's the opposite. You're being financially repressed. So I started thinking about this at depth, thinking, okay, if this is the reality, whether we like it or not, that matters not. The reality is we are actually getting poorer, and it's getting harder and harder for people. The rich-poor divide is getting bigger and bigger. What can we do about it? And so I started doing crazy stuff like, and people still to this day think it's a bit weird, I started dividing all asset prices by global liquidity to try and see which ones were outperforming this debasement, this 11% hurdle rate. And what we only get 2 assets in the world that really do it significantly. One is technology. So technology stocks, because we're in a technology age, the exponential age. Those things outperform. Yeah, Jamie, you're sharing a table, I think, on the screen as well.
Yeah, that's right.
That shows some of this. The other one, and equities themselves did okay. Australia did relatively okay, again, because of the structure of your economy and the fact that you also were producing physical, commodities which had value in this world. But what we found is there was one supermassive black hole that really helped us enormously, and it happened to be Bitcoin or cryptocurrency at large. But let's use Bitcoin. So Bitcoin actually is the fastest, best performing asset in all recorded histories. You can see by that table that Jamie's kindly put up, it is the most ridiculous performing asset we've ever had. And we have, I think it compounds at about 150% returns since 2012. That includes 3 70% plus drawdowns. So what we've got is kind of a super creature of investing. And what makes it so powerful is it's fractionizable and it's global. It's the first truly global homogeneous asset that everybody can access with a phone. Everybody can put 10% of their income in. You can't buy 10% of, real estate in Australia. You can't do it. Most people can't afford it, so the rich people can. Here we've got an asset that outperforms everything, that is basically tokenization of a technology, which is blockchain technology, that we can all participate in. And it is one of the great ways to unfuck all of our futures. And it moves so far and fast that it really makes a dramatic difference, even if you start with small amounts. So that's basically the backdrop of how I think about this.
Yeah, so, and it also feeds into your, your wider thesis around the exponential age and how we have, you can describe this far better than I can, but intersecting technologies or major secular trends with blockchain being part of that. And I think we'll circle back to talk about blockchain in just a little bit, but I want to touch on this because one of the things that you've put out in the last maybe 12 months has been this time frame that you've thought about where you think in the next maybe 5 to 6 years, things will change so dramatically that it's almost impossible to forecast beyond that point because of what's happening in terms of technological adoption and the types of technologies that are coming to the fore. Maybe if you could just touch on that. Now, obviously, we're talking about AI plus other things, but do you want to just give everyone here that distillation of that exponential age thesis?
Of course. And it's very important for people to understand this. The exponential age was something I came across, and I wasn't the first person to think in these terms, but I kind of started putting it in a macro framework, which is that we are living in an age where a bunch of technologies that are completely game-changing are all hitting network adoption at the same time. So network adoption is when the networks start going exponential as new people use these technologies. Now, we've seen that in the past. We saw it with mobile phone technology. We saw it with the internet. We saw it with home computing. Stuff like this we've seen, but we've never seen a nexus of maybe 5 or 6 of the most important technologies of all time all happening at the same time. So blockchain is one of them. It's a foundational layer. It's the truth layer to the internet. We can come back to all of this later. But AI is the big one. AI gets around a fundamental human issue, which is knowledge is scarce and is priced accordingly. And AI is infinite human knowledge. But it's not only human knowledge, it's going to become inhuman knowledge. Because currently, the leading AI models have an IQ of about 120. That's higher than the average person. But in every single subject known to humanity. Now, unlike Moore's law, which sees the power of chips doubling every 2 years, it seems that computer intelligence via AI is doubling maybe every year. So what we're getting is Moore's law doubled in this exponential rise of knowledge. So what it means is currently we're at an IQ of 120. By next year, we'll be at 240, then 480, then 1,000. This becomes la la land because what we've scaled is infinite knowledge. Now, we also have robots coming in, and robots scale infinite humans. Now, this is all well and good. We've got infinite knowledge, which replaces knowledge workers, but we've got an aging population. So it's kind of offsetting some of the aging population. It's kind of desperately needed for economic growth. And I'll come back to that in a sec as well. And then we've got the robots. The robots replace physical labor, and they're more productive than us. We add in new forms of electricity production, and that generates a flywheel along with compute. And then we can add in genetic sciences. And there's a whole bunch of these technologies that all come together at the same time, hitting mass adoption. Blockchain was the fastest adoption of any technology the world had ever seen. It was twice the speed of the internet. It continues at that speed today, vastly outstripping the pace of the internet in adoption. AI has been even faster. It went from 0 to 100 million users in about 4 months, which is something we can't get our heads around. So what does it all mean, all of this technology? Why is Raoul getting concerned about this 5 or 6 year period? Well, I think we're about to go through a rapid renaissance period where we become super productive. The world becomes an incredible world of abundance. But then things get really screwy. So when we look at economics suggests that trend rate of GDP is driven by 3 factors. It's driven by population growth, productivity growth, and debt growth. So on the population growth side, the entire Western world has got a declining population. One of the reasons why Australia has not had a recession for a long time outside of the short, sharp COVID was because you've got a high immigration rate, so your population is growing. Most of the world is not growing its population, and trend rate of GDP is falling. It is being offset by rising debts. So they're trying to use debt to offset this. But really, the debt lever broke in 2008. The other factor, the multiplier here, is productivity. Productivity is the amount of output per kilo of energy. Think of it as, probably the best way of thinking about it is electricity prices. Okay, so that's the world we're in. We're in a slow world of aging populations, low productivity because of an old population, and broken debt growth. And that includes China, Japan, the UK, the EU, the US, etc. Now, suddenly, we're about to start scaling the human side of the equation via AI and robots. Population is going to start growing massively. We won't notice it yet because we're not using the technology fully. It's rolling out. We're starting to get used to what can we do with this thing. It's improving every day. But give us 5 or 6 years and we will start to produce millions upon billions of AI models, AI agents, AI models, AI uses, AI applications. And suddenly, not only is it going to change what it means for work for us humans, which is a different issue, but it's going to change GDP growth dramatically because of the formula. That magic formula means that if you start printing 1 billion humans, 2 billion humans, 4 billion humans, GDP growth kind of goes wild. But who does it accrue to? Does it accrue to us as humans? Well, no, because we're not doing the work. We'll find different ways of working, but all of the work that we understand today, doctors, lawyers, accountants, bankers, radiologists, anything, those jobs are all going to go over time. Now, regulation will try and stop that, but that's where it's going. And then human labor, Amazon already employs more robots than they do humans, and that's going to go exponential too. So that's a multiplier on GDP. The next part of GDP is productivity. If you look at solar and the efficiency of solar and battery technology, these are absolute exponential. They're probably some of the strongest exponentials we see in the world today. That will continue over time. We add in nuclear, we add in decentralized grids as opposed to these large centralized grids we have, and the price of electricity will collapse to a marginal cost of 0 over time. So then we've got output from the AI and the robots and energy costs going like this. And what happens is you get this economic growth that goes wild. We don't know who it accrues to, but then once you start putting in this super intelligence, well, what does it mean for financial markets? How do you invest in anything when something is a smarter investor? It can see the patterns we can't see. It knows everything. Well, that kind of changes the game for us as investors. How do we generate and accrue wealth? We've done it via owning assets. Sure, physical assets like real estate, They won't be driven by the AI and the robots, but the financial assets that we trade on screens all day, well, that game becomes different. But also building a business becomes phenomenally difficult. Think of the world driven by software is eating the world, the famous Mark Andreessen quote. Well, software, this SaaS business model that we've all grown up with that's generated so much profit, now I can just show an incredible platform like Real Vision and show it to a superpowered AI and say, build me this, and it can build it in 3 minutes. So what is the moat to any product? Yes, it's community and it's humans, but outside of that, any business becomes a factor of attention. How long can that business get an attention before a new business comes along? It feels like the initial coin offering, ICO market of 2017, or even the meme market now. Velocity of capital becomes super high. The wealth creation destruction cycle is so rapid that IPOs, VC, private equity, none of these things work in the 2030s. So we're going through this profound period of change where first we're going to get this super acceleration of productivity, of asset prices, something we can really participate in, beyond which it becomes a very dark world I call the economic singularity, which I don't think of as a pessimist. I don't know what this means for us and how we're going to figure it out. So I kind of figure out we've got 5 or 6 years to unfuck our future, to solve the issue that we don't know what even the study of economics means in the future, what financial markets are, what assets are, what businesses are. So it's the period we need to really focus on wealth accumulation and to try and make as much money as possible. You'd rather go into this with your lifestyle covered, your future secure, and then we can figure out this complicated future. What I don't want to be doing is figuring it out while launching a new business in the early 2030s and everything has changed. So, it's kind of, we can see it ahead, like the steel mills in Sheffield in the UK or Pittsburgh in the US. We can see that these things are going to be closed down. We can see there's immense opportunity before it happens. So that is the ride we're on. And this is one of the key things for crypto that I try and tell everybody. It's like, I don't care whether you believe in, the libertarian angles. I don't care whether you believe that the technology is not for you. What you need to believe in is your future. And this is the only opportunity you're going to get to do that in this period of time.
Yeah, and I don't think it's a pessimistic outlook. It's just a very honest outlook, because I think anyone who's trying to forecast what the world looks like beyond the next sort of 5 years is, pulling our leg, because it's at this point, there's never been so much, distortion of the trend of like the future outlook because of the speed of the exponential trends in technology that we are seeing. It all comes back to sort of what we're seeing in the major secular investment classes, which we think has the greatest opportunity, which is blockchain, crypto, and also AI. AI is a lot harder to actually invest in as an individual, but a thesis which we've talked about, and I would say is becoming more mainstream, is this intersection of AI and blockchain. And so blockchain does look like the vehicle that already, just with humans, before AI even arrived, was on an exponential curve anyway. AI is just going to accelerate that. I think I've got a chart here, Raoul, from the presentation yesterday. And by the way, you distilled everything I said yesterday in a far more elegant fashion than I ever could. But the slide that we have on screen is looking at on-chain data from blockchains, so from layer 1s and layer 2s. Now, usually I would never put a chart in this format because, as you can see, you can hardly see the exponential growth in the first 8 years of these charts from 2018 to where we are today. But it has been exponential. But when you start looking at extrapolating that out, and of course, no one has a crystal ball, but if you just take some very conservative assumptions and build that into where the number of active addresses will be, or fees that are actually being paid by users of the blockchains themselves, whether it's AI or human, then you start looking at some very, very large numbers. And so, your thesis here, Raoul, on how AI is going to intersect with blockchain, what are your thoughts around this?
So people need to understand what is going on here. This is not just Bitcoin and a pristine collateral layer. It's not a bunch of cryptocurrencies that people are trading. What this is, this blockchain technology, is the security truth layer to the internet. Without it, the internet cannot progress with AI. AI, we're bringing in something we've never had before, non-human activity. Non-human activity and human activity will need to prove what is what and who is who. But also, as we go increasingly digital, every day is more digital than tomorrow. Tomorrow is always more digital than today. Everything from every contract that we do, all of this stuff, and humans live by a system of contracts, whether it's tickets, agreements, everything, even me turning up on the Zoom call today is a contract. All of these contracts, some have value, some don't. The ones with value are generally done via paper and some sort of ledger system of which somebody notarizes it, if you think about a property. But what we're moving towards is a way that we can do this digitally in a way that is trusted because there's no central party in the way. And so this scales everything from ticketing to value to artwork to money to everything. This blockchain also proves who is a human, who isn't. So we can prove these things. It's a proof layer that is distributed amongst thousands or millions of people that confirm what is the truth as opposed to one trusted party. So this scales as AI scales. It has to. Without it, we couldn't have AI, or we would entirely break society, money, and everything else. So even if I just take the trend rate of adoption, I think you've got this chart. The trend rate of adoption of wallets keeps increasing every day as new people start to use this. Now, as I said before, I've compared new wallets to IP addresses. I rebased them in the past back to 5 million as a starting point for the internet. Back in, it was like 92, 93, and I did 5 million wallets for crypto. Now we've all got multiple IP addresses, we have multiple wallets, so it's pretty like for like comparison. You extrapolate that out, by the end of this year, next year, we should get to about billion wallets. Okay, that's a lot. And now how many users? Well, that's a matter, Jamie, you're more qualified than I am to figure out what the exact number of users are. But the point being is this scaling is going to continue, and I think it's going to keep accelerating because now we're bringing these other economic actors, the AI agents in. And agents are, if you think about a website like Fiverr, you go to Fiverr and you say, hey, listen, I want to build a website business and I need a marketing plan, I need a deck to pitch to investors. And hey, can you design me my landing page? And can you do me my payment system and I'll pay you all for that? Agents are AI agents that go and do all the individual tasks under one bigger task. And those things will also get paid because they use compute and they use energy. And the easiest way of paying agents, because they can't get a bank account. Last time I checked, they don't have a utility bill. They can't get a bank account. So blockchain is a really quick and efficient way of streaming payments to all of these vast numbers, these billions of agents that are coming into the world. So we're going to see increased number of wallets, increased number of users. We are seeing AIs every day now on X, people experimenting at the nexus of crypto and AI, and AIs are opening their own wallets, starting their own currencies, payment systems, all sorts of stuff. So we're starting this trend. It's going to keep going. So what does it mean for all of us? Really simply, this is a $3 trillion industry today. It is going to 100 trillion by, let's say, 2034. 100 trillion from 3 trillion. Maybe I'm wrong by 50%, and it's a $50 trillion industry. If it's 100 trillion, we're only 3% of the journey. So all of you who say, oh, should I be buying Bitcoin so high, or Solana or Ethereum? 3%. It is going to 100 trillion or 50 trillion. It'll be the largest accumulation of wealth in the shortest period of time the world has ever seen. It is a mass redistribution of wealth. It ties back into the earlier conversation we're having. The reason it's a redistribution is savers are being penalized and workers are being penalized by a financial repression by the debt. That debt is a factor of the aging population. Nobody had kids. It was a function of World War II. We can blame governments all we want. It's actually a function of World War II populations and a bunch of other stuff. But the point being, in front of us lies the largest wealth generating opportunity of all time. and we're only 3%. If you just think of a little scale, and we're 3% of the scale, and all of that is blue sky. That's what we've got ahead of us.
I've actually got that chart up. Well, I've got my model up because we differ a little bit on the targets, but to your point, it doesn't really matter what that final objective is. It's going up, and it's going up a lot more than other asset classes. Last year at this event in Melbourne, the sort of, I guess the big meme of the industry was tokenization. This year, it's clearly AI integration into blockchain, that intersection. But it is tokenization that gets the asset class to those, eye-watering levels. Because at the moment, it's a very narrow asset class doing very narrow things. AI is going to expand the use cases, and all that friction that we feel when we're using blockchain today, which will ultimately get solved, but in the end, for AI, that friction is meaningless. It can hop between chains, it can do more complex things, it's multi-dimensional in its thinking, and it has more patience than we do. So that is all sort of compounding into the asset class as well, and that's why even myself, when I talk about these levels, I have to pull myself back and think, am I crazy? But it's actually quite logical. Now, the targets and the objectives of the final price where it is in 2030, it's really don't get tied up in that. That would be my insight for everyone, because at the moment, if you just look back at what it's done pre-AI, I think we can safely say that it is going a lot higher, and it's going to go a lot higher than and faster than other asset classes.
So Jamie, a way of thinking about this for people who are not quite sure, because blockchain and crypto have lots of narratives and people latch onto different ones. The one that I found resonates with people who are not in it on the money side, but just want to understand the technology. This is the new version of the internet. It's called Web3. Whether that name changes over time or it sticks, it's irrelevant. But the point being, it's just the new version of the internet that we need for the present times. Now, the internet was the greatest technological boom of any of our lifetimes, and one of the greatest inventions of all of humanity. It was a way of humanity coordinating humanity in a digital age. It created pretty much the digital age. Now, none of us could participate in that. It was a public service utility good that made a bunch of VCs and a bunch of companies very rich. But us lot, it didn't really do anything for us. Our lives got better in many ways and worse in other ways, and it got more convenient, but we didn't participate in the wealth. Think of all the wealth that got generated in Silicon Valley, where I am today. I mean, there is staggering wealth here. And most of us didn't participate. We became their product. Now here, the magic is, how blockchains work is they have an economic incentive system, which is a token. And that economic incentive system incentivizes you to use a network. And the more you use the network, the more of these tokens you get, and also the more they go up in value. So you've got this economic incentive. So if you think about it in other terms, imagine when Facebook launched in 2012, imagine if they'd given every single user a Facebook share. What would be the value of Facebook, and how much wealth would it have created for humanity? This is what this technology does. It is incredibly powerful economic incentive machine to bootstrap the next version of the internet in record time. That next version of the internet gives us almost infinite use cases, whether it's to do with money, the entire global financial architecture, whether it's to do with value, whether it's to do with ownership, whether it's to do with identity, or whether it's to do with AI and economic systems that are yet to emerge. That's what it's here for. That's the infrastructure that is being set up. That is why people are making money out of this as we start hitting adoption curves, as we're testing out these new technologies for mass scaling. It is an extraordinary time to be alive.
Yeah, and I think as we've run through this discussion, we've talked very, very high level, and we've also talked, I guess, at the technology layer as well. But it's an investment or an asset class as well. And with your 30 years, 35 years experience in financial markets, part of what you do is not only talk about the investment opportunities, but essentially what the traditional finance guys would talk about in terms of risk management, but I think you've coined the term "don't fuck it up" as another way to express that to the general public, because this asset class, like no other asset class, brings out the best and the worst in people. And that's a function really of the money system and the debasement that we all feel. So I think, we've got sort of 10 minutes left, Raoul. Why don't we sort of just go through those really important aspects of how to invest in this space and how to not fuck it up and make the mistakes that, quite frankly, we've all made in previous cycles.
Okay, so firstly, you need to throw out everything you understand about investing. Everything you've ever been taught, everything your financial advisors told you, throw it out. They tell you run diversified portfolios, do this and that, and running stop losses, all of this stuff doesn't work in this. The reason Jeff Bezos is one of the richest people in the world, or Elon Musk, is they don't sell their shares. And that's what you have to do here. Your game is to hold on to your goddamn tokens from 3%, $3 trillion to $100 trillion. That's the game number one. That's not trading around it. That is not using leverage to try and juice extra returns out of a asset class that produces la-la land returns anyway. You don't need leverage. You just need time. You need patience. You need to expect 35% drawdowns in bull markets many times and not be phased. You need to expect once every 4 years, a down 70 or down 80% market, you'll feel terrible. But 3 years later, you'll be at all-time highs and accelerating through them, and your wealth will be compounding. I had dinner last night with a friend of mine who invested first Bitcoin at $3, and he still holds it to this day. He's now become one of the richest people in Silicon Valley, and very quietly just did this one trade, didn't really do anything else. So that's one thing. The other thing is, once you're in this space, you start to see other people making more money than you. You see them making 100x on a meme coin or 1,000x. They start showing their P&Ls on Twitter, and you start to feel like you're just not getting it right. You're holding in Bitcoin, Ethereum, and Solana has only gone up 250% in the last year, and it's just not good enough. You've got to stop thoughts like that. That FOMO will force you to buy stuff you shouldn't buy. You will go too far out of the risk curve, and you will end up caught as the tide goes out, and you will lose the money. And if you lose your money, you lose the ability to participate in the mega trend. Rule number one, don't lose control of your tokens. And that brings you into, okay, so how do I asset allocate? It's complicated. There's so many cryptos. Well, if you just want to keep it simple, stupid, just buy Bitcoin, go to the beach and don't do anything. It'll outperform any business that you ever create in terms of annual performance. I mean, that's a horrible thought that I've realized. But at 150% performance, even if it comes down to 50% a year, most businesses don't grow at 50% a year. So it becomes very difficult to even justify starting a business, which is a bit weird. But really, how I prefer to see this space is it's a broader adoption than just Bitcoin. Bitcoin is one of the big use cases, but it's not all of the use cases. And so I would just take the three most prominent coins of the moment, which is Bitcoin, which is, let's call it the pristine collateral, the security, the safest asset. I would take Ethereum, which is the broadest, deepest asset. And I would take Solana, which is the new fast entrant that is rapidly gaining massive adoption effects. Hold those with 80 or 90% of your portfolio and do nothing. You just don't need to do anything. Then there is that inner degen inside of you, that part that wants to trade other stuff, that wants to trade in memes. Well, do that with the 10% of your portfolio. I pretty much guarantee, because I've tried this a couple of cycles now, that bag of investments is usually worth about zero at the end of it. You've had a lot of fun, but you've lost all of the money in it. But you'll be more than offset by your major allocation. So it's things like this that are really, really important, is don't use leverage, because leverage means when the price goes against you, you lose your tokens. Don't buy stupid shit. Don't go too far out the risk curve with too much, because if that token doesn't work, you've lost control of your money and your ability to participate in the big trade. Don't FOMO into stuff because you don't understand it either. You don't know, you don't have an edge, don't pretend you do just because your mate told you. You know, the reality is that every time a friend of mine tells me to buy some meme coin, and I'm in a weak moment, maybe I'm tired, maybe I'm hungover, and I buy it, it usually goes down 80% almost immediately. So don't trust your friends either on their tips because they're not very useful for that. But these are really the important things. The other thing is, how else do you lose your token? A lot of people look for yield. And I don't have a problem per se with yield. I've never been a yield guy. I'm a macro guy. I'm a price guy. But yield, if you're putting your tokens in control of somebody else to generate returns and you don't know where the returns come from, it probably works for a period of time, and then at some point it may well blow up. And then you've broken rule number one. You've lost control of your tokens. So you need to be really careful with leverage. The other thing is, this is a bearer asset. What a bearer asset means is you need to take control of it yourself. Now, you can keep it on an exchange, and I think the big exchanges, the very big global exchanges, are relatively secure. But the beauty of this asset is you can be outside of the system by storing it yourself. And that is storing yourself on something like a ledger device. Doing that gives you the maximum flexibility. Yes, it can be a bit terrifying, but the key is not letting somebody else take control of your coins. Again, you'll be so upset if you don't have your tokens and you lose them because you got hacked, because you were storing them on your MetaMask wallet and you went to a website to buy some stupid meme coin and it was a scam. You've got to be really careful. This wallet cleanliness, separating your assets, using a different wallet to operate in the Web3 world versus a different wallet where you store things safely. Do these things and you will increase your probability of not fucking up. We will all get something wrong somewhere, so don't worry about that. But this is my kind of recipe for the highest probability of success, where I can bring as many people along on the ride as possible. And that would make me very happy indeed.
So rule number 2, rule number 3, rule number 4 is see rule number 1. Don't lose your coins. Listen, Raoul, thank you so much for your time. You have a wonderful
Jamie, I'm just going to give an example. I'm going to give an
please.
Example of losing my coins. I put this on Twitter the other day. I saw this trade early, 2013 earlier than pretty much anybody else in the kind of finance world. I saw the trade, I did the work, I wrote the first ever macro strategy piece on how to value Bitcoin. I came up with a valuation of 700 ounces of gold per one Bitcoin, which at the time was about $1 million. I discounted myself by 90%, said, look, even if it's 100 grand, it was $200 at the time, then this is the best macro opportunity of all time. And it remains so to this day. So I bought it at $200. It went up 5x in 2 months. I'm like, well, clearly I'm an utter genius. George Soros has got nothing on me. It then falls 87%, but I knew it was a long-term trade, so I wasn't worried. I treated it like an option. But I put a decent amount of money in. It was like 200 grand back in, whatever it was, 2013. Then it rallied into 2017. It was now up 10x. The magic of Bitcoin. It can forgive every bad entry as long as you give it enough time. So it was up 10x, and there was some weird confusion over Bitcoin forking into 2 different chains. I didn't understand it. I'd made 10x. I took my money and I was like, I'm brilliant. It went up another 10x in 4 months at the back end of 2017. I'm like, oh my God, I've never seen that. Anyway, I ended up buying back into it in 2020, into the COVID crash, and then added to the trade, etc. I just worked out yesterday, I kind of figured out that I would have done 5 times better by not having sold it. And then I kind of figured out the numbers, and I left hundreds of millions of dollars on the table by that one decision, versus the friend of mine who bought it at $3 here in Silicon Valley and did nothing. The point is, I lost control of my tokens. I purposely got out of the market, because we all think I'm a macro guy. I know how to time markets. I sold into a rally. I bought it in a dip. I completely screwed it up. So doing nothing is actually the easiest thing, but it's so hard for people. But that's what I would recommend.
Raoul, thank you once again. I really appreciate you spending your, I guess, early evening hours with us here in Australia. I think on behalf of everyone, would like to thank you very much for all the work that you do. Australia loves you, especially customs officials.
And I've got my Banana Zone sweatshirt on.
Oh, we didn't even touch on the Banana Zone. We'll have to get you out here in person next year. Thanks very much, Raoul.
All right. Take care, everyone.